Welcome to this explainer. Today, we're going to do things a little differently. I want you to step into the shoes of a global financial regulator. Just imagine it. You're sitting at this massive mahogany desk and you're looking at the state of global cryptocurrency in the year 2026. The days of treating digital assets as a passing fad, actually, scratch that. The days of treating them as even a fringe experiment are completely over. The ecosystem has totally evolved. The stakes are literally higher than ever, and the entire world is looking directly at you to figure out the rules of the road. And that brings us to the massive, multi-trillion-dollar question hitting your desk this morning. How exactly do you regulate a borderless financial system? Because as a regulator, you're faced with this incredibly tricky dual mandate. On the one hand, you absolutely have to protect traditional financial markets from systemic contagion, right? You need to ensure institutional safety. But on the other hand, you're dealing with a decentralized technology that just seamlessly crosses borders and operates totally outside the traditional banking rails. You can't just flip a switch and shut it down, but you definitely can't let it run wild either. Section 1. The Regulator's Reality Check. Okay, let's dive into this. To effectively regulate this space, we've got to look at the concrete data and leave our old assumptions at the door. Here's your morning briefing breaking down the top trends from the PwC Global Crypto Regulation Report for 2026. We are shifting heavily, and I mean heavily, from just designing policies to strict implementation. Stablecoin regimes are finally becoming operational. Tokenized money, things like bank deposits and wholesale central bank digital currencies, they're moving out of cute pilot programs and into scaled real-world deployment. Consumer protections are being forcefully baked right into licensing frameworks. Decentralized finance and trading venues, they're converging toward global market integrity norms. Digital assets are seriously expanding as eligible collateral, and we're seeing way stronger prudential rules for intermediaries. Basically, the Wild West era is officially ending. The whole situation is captured perfectly in this quote from the PwC report. Regulation is no longer shaping crypto from the outside. It is being pulled into place by market reality. So what does that actually mean for you, the regulator? Well, it means crypto is no longer just this speculative asset sitting on a random trading venue. It has functionally moved into the global monetary system. It is moving, settling, and managing real money in real time. Your rulebook isn't dictating the market anymore. The market's integration into actual economic activity is forcing you to write the rulebook. Section 2. Taming the stablecoin boom. And nowhere is this market reality more pressing than with stablecoins. Dante Disparted from Circles sums up the current mood perfectly. We are entering an era of highly compliant, programmable finance. For standard-setting bodies all over the globe, stablecoins are the absolute top priority. We're completely out of the consultation phase now. Frameworks are converging on some really strict requirements: full reserve backing, the ability for users to actually redeem their assets at par value, segregating customer assets so funds don't get mixed up, and strict anti-money laundering compliance, especially the FATF travel rule. So yeah, the grace period for stablecoin issuers is completely over. Now, what's really interesting here is this geographical divide. It's a pretty stark contrast. On one side, you've got traditional, formal financial centers structurally deeply integrated into the US dollar system. But then, look at the emerging digital dollar zones and unregulated hotspots. In those regions, stablecoins are actually extending access to US dollar liquidity through informal digital rails. So for you as a regulator, the takeaway is huge. Stablecoins aren't just a domestic headache. They are actively redrawing the map of global dollar dominance, and they're doing it way ahead of your full regulatory frameworks. Section 3. Tokenization and institutional money. While stablecoins are spreading globally, there is a massive shift happening right in your backyard with institutional money. Take a look at how major global financial hubs are actively building out their rulebooks. The European Union and the UAE, they've got comprehensive legislation already in place across the board. The US and the UK are in active engagement, which basically means they are rushing to finalize their tailored regimes. As a regulator, you're witnessing this massive top-down rush. Traditional Wall Street and global asset managers simply aren't going to move trillions of dollars onto blockchains unless they see those green in-place check marks, giving them the legal certainty they absolutely demand. Let's zoom in on Europe for a second. The European Union's MiCAR framework, the Markets in Crypto Assets Regulation, is pretty much the gold standard right now. But the story in 2026 isn't about making the rules anymore. It's all about delivery and supervision. Europe is actively categorizing tokens, figuring out which ones pose systemic risks, and applying super rigorous capital and operational resilience rules, like DORA, the Digital Operational Resilience Act. What this means is that if a crypto firm wants to operate in Europe today, they have to prove they can withstand cyber attacks and market crashes just like a traditional, heavily regulated bank. And because we finally have that regulatory clarity, we are seeing the lines blur big time. Traditional finance is heavily integrating digital assets. Take jurisdictions like Hong Kong SAR, for example. They're actively blending these two worlds together through initiatives like Project Ensemble, which tests wholesale central bank digital currencies for seamless on-chain settlement. Plus, they're regularizing the issuance of tokenized green bonds. Make no mistake, the institutional financial machine is officially absorbing blockchain technology. Section 4, the Grassroots Crypto Lifeline. Okay, let's pivot here, because while you've been totally focused on Wall Street compliance, there's a massive blind spot you simply cannot ignore. I want this number to really sink in, 87%. According to Alex Gladstein's research, 87% of our planet's population is born into autocracy, or, a considerably less trustworthy fiat currency. They don't have the luxury of defaulting to the dollar, the euro, or the British pound. For literally billions of people, the traditional financial system you are trying so hard to protect isn't protecting them at all. In developing nations, the reality on the ground is completely disconnected from institutionalized tokenized green bonds. Take Nigeria, for example, dealing with 15% annual inflation, or citizens in Sudan, Ethiopia, or Afghanistan facing intense state-led monetary repression. In these unregulated hotspots, digital assets are not some speculative bet to get rich quick. They are a daily economic lifeline. They're literally a tool for survival. Consider this incredible anecdote from Ire Aderonokun regarding the feminist coalition in Nigeria. During nationwide protests against a notoriously brutal police unit, the regime cracked down and completely shuttered the activists' traditional bank accounts. Just like that, they were totally cut off. So what did they do? They pivoted entirely to the Bitcoin network. It was the only viable way left for them to receive, store, and spend money securely and privately. The technology allowed them to bypass the state's financial blockade entirely. And why does it work so well for this exact use case? Because of its core architecture. As Jack Mallers points out, this technology allows users to accept payments instantly, with final cash settlement, no central intermediary to freeze the account, and without relying on what he playfully calls the 1949 boomer network of credit cards. It is peer-to-peer, borderless settlement. As a regulator, you have to realize that this humanitarian utility relies on the exact same decentralized features that make the technology so incredibly hard for you to supervise. Section 5. The global regulatory convergence. So, how exactly do you bridge this massive gap between institutional Wall Street and a grassroots activist in Nigeria? Well, the Financial Stability Board, the FSB, is trying to unite these fractured realities. Their high-level recommendations are driven by a pretty simple principle: same activity, same risk, same regulation. They're pushing hard for consistent oversight, demanding strict licensing and governance obligations, and setting firm standards for global stablecoin arrangements. But here's the catch, and it's a big one. While the frameworks are aligning in theory, the implementation remains incredibly fragmented globally. Many jurisdictions out there simply lack the mandate, or frankly the resources, to effectively supervise these borderless assets. And that brings us right back to your massive mahogany desk and your ultimate balancing act. You are now forced to manage two fundamentally different worlds simultaneously. On one side, you have the top-down institutional compliance world, focused entirely on market integrity, enforcing MiCAR, DORA, and the travel rule, and facilitating tokenized collateral. But directly opposite that, you have the bottom-up humanitarian utility, where this exact same technology acts as a crucial financial lifeline against inflation, a tool of resistance against authoritarian censorship, and a means of borderless survival. Which leaves us with this final, genuinely provocative thought. As you draft the policies that will define the rest of this decade, you really have to ask yourself, can we build a safe, highly compliant financial system without accidentally crushing the vital, global utility that billions of marginalized people rely on? That right there is the true challenge of the 2026 digital asset landscape. Thank you so much for joining me on this explainer, and I'll leave you to ponder that vital question.